Okay, so gold prices are absolutely soaring, and every investor out there is asking the same question. Where's the next big win? Well, you might want to look at CNMC Goldmine Holdings. They're scaling up their operations in a big way. But here's the million-dollar question. Is this a golden opportunity, or are there some serious risks hiding just under the surface? Let's get into it. The bull versus the bear debate.
All right, here's the game plan for our debate. First, we'll set the scene and ask, is this really a golden opportunity? Then we'll dig into how they're scaling up production. After that, we'll look at the money. Are they cashing in on all this gold? And of course, we'll look at their future plans for growth. Then, at the very end, we'll bring it all together for the final verdict. Let's jump in.
So let's set the stage for this showdown. I mean, you couldn't ask for a better setup for a gold miner, right? Gold prices are through the roof, and CNMC is pouring money into a huge expansion to pump out more gold. On paper, it looks like a slam dunk. But is it just a little too good to be true?
So you've got two camps here. In one corner, you have the bulls. They're looking at this and seeing a perfect storm for growth. You've got higher gold prices and higher production. What's not to love? But in the other corner, you have the bears. They're a bit more cautious. They're worried that all this excitement might be making investors ignore some pretty big risks. So let's see which side makes a better case, starting with the company's production.
Okay, let's talk about scaling up production. Honestly, this is where the bull case really starts to get exciting. CNMC just finished a massive expansion of their processing facility. But the real question is, what does that actually mean? Are they really getting bigger, faster, and better?
All right, let's hear from the bull. The first number you absolutely need to know is this: 60%. That's how much bigger their carbon in leach, or CIL, processing facility just got. Now, CIL is basically the high-tech process they use to pull gold out of the rock they dig up. So a 60% boost, yeah, that is a huge deal.
And what does that 60% actually get you? Well, it means their daily processing capacity shot up from 500 tons of ore a day to a whopping 800 tons. And here's the kicker. This isn't some future plan. They're already running at this new full capacity right now.
But wait, there's more. This upgrade wasn't just about getting bigger, it was about getting smarter. They've installed a new dual circuit system. What that means is they can do maintenance on one part without shutting the whole thing down. That gives them much better production continuity, and, this is the important part, better gold recovery rates. So bottom line, they're getting more gold out of every single rock they process. Aha, but hold on! Here comes the bear with a dose of reality. This quote really hits on a fundamental risk in any mining operation. See, you can have the fanciest, most efficient factory in the world, but your final product is only as good as the stuff you put into it, in this case, the ore. And the quality of that ore, what they call the grade, can be super unpredictable. CNMC tries to smooth things out, sure, but that volatility, it never really goes away. Okay, so we know production is ramping up, but is that actually turning into cash in the bank? Let's switch gears and look at the financials. Are they really cashing in on all this gold? And more importantly, is it sustainable? And wow, when you look at the dividends, the bull case just explodes. Check this out. The dividend per share has jumped 7-fold in just 2 years. To give you some perspective, the dividend they've already paid out for the first half of this fiscal year is more than the entire payout for all of last year. Now that is how you return value to your shareholders. And get this, they're not even breaking a sweat to make these payments. The company is sitting on a net cash position of over $37 million. That means they have plenty of cash to fund their next big projects without having to borrow a dime. So the idea of even bigger dividends down the road, yeah, that's a very realistic scenario. But the bear steps in and says, hold on, let's talk about the valuation. Yeah, the revenue forecasts look amazing. But look at the price-to-earnings ratio, or PE. That basically tells you how much you're paying for the stock compared to its profits. Back in fiscal year 23, it was at a crazy high 88.9. Now it's come down, but it's not exactly a bargain. In a cyclical business like mining, a high PE can be a warning sign that everyone's expectations are already sky-high, leaving zero room for error. The bear is basically asking, is all the good news already baked into the stock price? All right, let's shift our focus to the future. We're talking about the company's biggest project on the horizon, the new Socor underground mine. This is supposed to be the next big growth engine. But you can bet this is where the bull and bear debate really gets intense. So, from the bull's point of view, going underground is a really smart play. Think about it. For a decade, they've been doing open-pit mining, basically scooping up the easier-to-get ore. Now they're digging deeper. This lets them target much richer, higher-grade gold. Yeah, it costs more to get it out, but the value of that high-grade ore should more than pay for the extra effort. But this is where the bear raises a huge red flag: delays. The original plan was to have this mine finished in 2025. Well, that's already been pushed to the first half of 2026. And as you can see, there's a very real chance it could slip even more, maybe not even starting operations until 2027. That's a big deal. So, what's causing these delays? Well, this isn't your average construction site. We're talking about building a mine deep in a Malaysian tropical rainforest. That kind of environment comes with some unique and pretty massive challenges, especially when it comes to water. We're talking about serious water accumulation issues. If they can't get a handle on the water management, you can expect even more costly delays, pushing that big payday further and further into the future. Okay, so we've heard both sides of the story. On one hand, you have impressive operations and profits that are just soaring. On the other hand, you've got real questions about the stock's valuation and some serious risks with their biggest future project. So let's try to bring it all together for a final verdict. And this really is the question any investor has to ask themselves, right? How do you weigh those exciting, powerful catalysts against the very real risks that could derail the whole thing? Let's put them up side by side and see how they stack up. So here it is, the final showdown. The bull case really hinges on these key catalysts: the potential for even higher dividends, the huge upside if they can actually finish the Soker mine early, strong revenue growth, and of course, gold prices staying high. The bear, on the other hand, is laser-focused on the risks: more delays at the Soker mine because of that water issue, the simple fact that ore grades are always volatile, the potential for costs to go up, and the company's total reliance on the fluctuating price of gold. A lot to think about. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.